So thank you everybody for joining. I see Asim is there too. I'll make a few announcements and then Asim will unmute himself and I'll introduce him and hopefully we'll have very productive conversation today. I really like Asim as a person and as a trader, and we're going to get in depth into a few things. Just a few announcements, before we start. Again, thank you to everybody who's participating in our community forum. Thank you, Ben, for starting out the thread today, which will be really good. So, Jake, do you want to post to the last thread that Ben did right over here, or Ben could even post it here about talking about good traits of a trader. Maybe you want to post it there. So I would want all of you to participate in this thread. Let me tell you just a little bit of what we're doing with the community shortly. So I'm working with a programmer who is going to count the number of words that each one of you contributes, gives you ranks, and just kind of give you an idea of who's contributing things, who's valued, in terms of contributing to the community and so forth. So that would be really good for everyone. If you post over there, okay, I'm sending this Saturday the 9 people that I've posted to the last thread a book that I really like. This one from Tim Grove, and I really promised it's a good motivational book. And what I'm going to do, he just came out with a second book. So whoever posts over there, okay, I will send them a book. It's not a lottery. You just post and just look at the subject and listen to today's webinar, and then think about what traits you want to develop as a trader, what you're trying to overcome, your difficulty, your challenges, and it will be a good kind of sense of your self-expression, of admitting to your weaknesses and everything else, right? And at the same time, setting goals of what you want to become, what kind of trader you want to be, and it's absolutely be perfectly honest with the community of saying, this is my weaknesses, this is my strengths, and everything else, right? It's really good. I admit to my weaknesses every day. I try to work on my strengths that I have and try and make it better and better. Okay, so again, please post to the community. Would really appreciate it. I'm trying to grow this community forum and have as many participants as possible. I read it all the time. It gives me good perspective. We had a guy by the name of Jeff. And again, just to give you an idea how exchange of ideas were really good, where I came and I told him, listen, you're focusing too much on the dollars. You're focusing on, I made $20 today, $80 today, $200 today. I lost 300 there, instead of focusing on the process. And it seems like he turned the corner because he just said, hey, that's what I'm doing. We saw what he did. And, we were able to give him good advice. And I hope he continues that way. Okay, so now I'm going to introduce Asim. Because both of us are licensed in the industry, I have to give you this legal disclaimer that there's a substantial risk of loss in futures trading. Past performance is not indicative of future results. We're not in the business to tell anybody to tell futures, to trade futures. If you trade futures, you're assuming the risk, and we hope that you only use risk capital when you do it. It's a leverage product. It's not an investing product. It's purely speculative trading product. So let me just introduce Asim and let me tell you why I'm such a big fan of this guy. So a few years ago, I came across Asim, and we always have customers that call us and say, look, I'm a busy individual. Can somebody trade our capital? We don't have a lot of those, but we have once in a while people coming and asking us to do that. And what I do, I try to do research in the industry, talk to the money managers and everything else. When I was a younger broker, much younger broker, one of the biggest mistakes that I've done as a broker when I was looking for traders and good traders is to truly focus on the results, right? So just like everybody else, I went and I saw 1 year he made 10%, 1 year he made 15%, 20%, that's it. Here's what I missed in the process. What I missed in the process of interviewing all those money managers was asking them, what sort of risk do you assume when you take those trades? What is your strategy? How much leverage do you use? And above all, sometimes I didn't ask the money manager enough questions in terms of, the personality they have, an attitude towards risk, right? So you learn over time that, and appreciate the fact that it's not only about results, but also the personality of the person and his attitude towards risk. And his attitude towards risk will dictate what he does during difficult times. So when I spoke to Asim the first time, I would say he was the least arrogant person with a good track record that actually we had a full understanding when we talked about risk. He didn't dismiss anything that I said. He didn't say, look, we have it under control. Look at our track record. He didn't say anything along the lines of, we got this. All along the way, he said, yes, the risk is here. Yes, this is the challenge. This is it. And it was truly refreshing to find somebody who is really truthful about the risk and the challenges that he faces. So without further ado, Asim, welcome. And thank you for being here. I appreciate your time very much. And so let's start. So first, do you want to tell the community maybe how you got into trading?
Yeah, thanks, Matt. Can you hear me, by the way? Just to double check.
I can hear you fine.
Okay, good.
Nice office, by the way.
Thanks. Yeah, we're in the office right now. We're in a WeWork in Boston. For those of us that are wondering where we are right now, three of us at AG Capital. So let me give you my quick background. So we've been working on AG Capital for the past 6 years. We built up a small CTA business. Started off with $500,000 and have gotten it up to 75 million, give or take. So it's been kind of building it up brick by brick over the past 6 years. But maybe for this meeting, the more important background is the background for the previous 15 years before I started the business in 2014. So the time period from 2001, when I first started trading, to 2014, when I set up the business, call it those 13 years. I have no professional background in finance. I never worked on Wall Street at a hedge fund, never worked at an investment bank. I wanted to. I applied probably 500 times over the course of my 20s and early 30s to different firms. I got rejected. I got some interviews. I never got to the point where I got a job. My professional career was in consulting firms, so I'm really good at making PowerPoint slides, and I'm good at using Excel, and I'm good at talking sometimes. So anyway, I spent a long time at a variety of consulting firms in Boston. Not worth getting into which firms they are. They're all prestigious firms, but it's irrelevant to the conversation. More importantly, when you go back to that time period in 2001, I was in grad school, and I read a couple of books, like many people probably in the audience, as to how I got into this industry. Either you found something on the internet. Back then, the internet wasn't a big thing. But I read the original Market Wizards book by Jack Schwager, which probably half of you have read. And then the other book I read that was fascinating was Reminiscences of a Stock Operator, which is a 100-year-old book about Jesse Livermore's experiences trading. Anyway, I read the books and I fell in love with it. I said, this is amazing. This business of trading macro, currencies, commodities, stocks, bonds, everything in the world. It's a mix of history, math, econ, all these subjects I loved in school back when I was in college. And so I opened up an account at, I'm trying to remember where it was, I think it was Refco. There was a broker that no longer exists. I put in 20K in the accounts, and I was successful a little bit. The 20K turned into 25K, 26K. And then 4 months later, I turned the 26K into 3K. And that's the first lesson is I blew up that account. Didn't take long, over leveraging trades, didn't know what I was doing. Not a big deal. So I started studying the markets a little more. And over the next, let's call it 5-6 years, I went from trying to figure out day trading to swing trading to trying to build my own trend following system to then trying to use fundamental analysis from the things I learned in Econ 101 in college. And the reality is none of it worked for me. I just sort of failed over the next 6 years. I had some good runs. There was a period where I actually took Another account that had 15K, I got it up to 60K, and then back down. There was one time, which I don't talk about, but I took an account from 50K to 800K. I got lucky on a bunch of trades for 6 months, and then I lost it all. So the thing people don't talk about is they don't talk about that stuff. They don't mention how they've lost all their money multiple times, not just once or twice. I made and lost a lot of money, but I always lost all of it over the course of maybe a year or two. I would round trip. And starting probably around the year 2007, 2008 was when I said to myself, I can't keep doing this. I mean, I'm spending 40 hours a week, nights and weekends. I still have my day job, obviously, trying to learn how to trade futures so I can, pitch a track record to some hedge fund and get out of my consulting job that I don't like doing. And I said, what first principles can I go to in this business? So I started looking at my trades and I said, at the end of the day, it's gambling. At the end of the day, it's gambling when I'm trying to look at some tiny little technical pattern or figure out what some fundamental is going to do when the market's looking at something different. And I said, there are some big moves. The big moves might happen for 5 years. The dollar can go into a bear market. Copper can go up for a few years. These big moves happen for a reason. They happen because there's a supply-demand mismatch. It doesn't matter if it's a currency or a commodity. I need to start focusing on those longer-term, bigger moves and cut my leverage down by 10 times. Instead of trading 10 contracts, I have to trade 1 contract. And very, very slowly over the next 5-6 years, I started to become profitable, learn more about risk management, which I already knew about. I understood risk management from day one, but I just broke my own rules for a decade because it's very hard to keep to the rules. The business is psychology-based, not math-based. Anyway, fast forward, I started getting more and more profitable, sticking to these longer-term themes, thinking, month, 2 months, 3 months, 5 months, multi-year investment themes with a longer hold time. And that's the genesis for then setting up the business to do that professionally. Was once I felt I really had my legs under me and I was profitable for a few years, I said, okay, now is the time to set this up and go for it. So let me stop there, see what you think, Matt. That's my honest background. No kind of punches pulled.
You're a straight shooter. You always have been, and I'm. If anything, I'm always have a smile on my face when I talk to you because I'm happy for your success. You deserve it. I remember when you started as a small money manager, and I'm happy to the growth that you have and the recognition. And I remember how hard it was in the beginning because there's a lot of money managers out there, and they claim all kinds of things. So I'm happy for your growth. One thing I wanted to, the questions that I wanted to ask you are ones that could help our traders out there. One thing I wanted to ask you, as far as, I'm always fascinated with not so much the market. I'll be honest with you. I do not like the market. I think market is noise, and the CNBC and the CNN and Fox News, and they just see, CBS Market Watch, Yahoo Finance, they bombard people with facts. There's a lot of gurus out there that don't trade or throw courses out there. So there's just, so from that perspective, that's what I don't like about the market. So what I do like about trading, though, is the decision-making mechanism, right? So I just wanted to ask you from a decision-making standpoint, how did you evolve over the years to make better decisions in trading? So consider your worst days where you took the account from 50, to 800, and then you blew it, versus your attitude today as far as decision making. I'm not talking so much about risk management, and we'll get to that, or where you buy or wait or where you sell, but just overall decision making. How did you evolve over the years as a trader?
I think of decision making as part of the style of trading you're doing. So it has to be married to your personality. So in my case, many of the mistakes that I made were based on over trading and thinking that I knew something, that I would have 3 winning trades in a row, and all of a sudden I would think I had this thing figured out. I know I could double my account in the next 3 weeks, and I would put on a huge position and then lose it all. So I looked at myself and said, my mistake is overconfidence. I got good grades in school. I worked at all these fancy firms in Boston, and I must know something. I must be smart. And the markets don't care who you are, where you came from, what grades you got in college. They don't care at all. And in fact, I will say something controversial. In some ways, the smarter you are, the more academically oriented you are, the tougher it's going to be for you to be consistently profitable. In some ways, you want to focus on your psychology and not so much on your intellectual horsepower. But anyway, that decision making for me, to get back to the question, I knew that I was making stupid mistakes, sometimes putting on big positions out of the blue, gut feel based things that don't make any sense. So I said, the first thing I'm going to do is slow down. And part of it comes back to that point I made where I want to look at these multi-month moves. And to slow down, I said, I'm done putting on random trades in the middle of the day. I'm going to make all of my decisions based on my nighttime reading of the charts. So I download daily data. I still do this today. I've been doing this for the last 10, 12 years. I have a software package. I download daily data, and I only look at daily level data and above, meaning weekly, monthly charts. I don't waste time looking at intraday, hourly, 15-minute charts. That might work for somebody else, but my style is longer term. So at night, I go through all my 40, 50 charts. If something's interesting, I don't necessarily have to do anything. Many days I don't trade at all. If something starts to bubble up over a number of days and weeks, the chart looks interesting and I've been studying the fundamentals during the day, only then do I start to think, let me put on a trade. And then so slowing down is the key to my decision making. And then you just have to know that over the long term, things play out. I'm wrong more often than I'm right. Take the loss, that gets into risk management. But the decision making for me is all about slowing down, nighttime chart review. During the day, I just read. I'm spending 4 hours a day reading research. Sure, I follow my trades. If something gets stopped out, I have to take action. But I'm not putting on new positions in the middle of the day, feeding a slot machine. I'm doing more of a slow, methodical nighttime and weekend review. And I probably trade 3 days a week, 3 new kind of positions I put on per week, roughly speaking. So 100, 125 at-bats per year, which doesn't sound like a lot. People, when you're trading, you can probably do that in a week if you're trading a lot. I used to. But now I do 100 to 125 trades a year.
Right. First of all, thank you for sharing this with us as far as your decision making and how you go about it. Just to let you know, Asim, is a longer term trader. So his account sizes for the customers are a little bit bigger. He's not a day trader. Nevertheless, all of you out there that are day traders, just pay attention to his decision making. Look how he evolved, and thank you for sharing your experience coming from, doing random trades where you think something, and to the point where you're saying, listen, maybe I have to start over. I do not disagree with you at all about the idea that the smarter the person is, the more challenge he may have when it comes to the market. Because if there's one thing that I have said to traders, that your personal strength in life might be a weakness in the market. So, for example, if you're an engineer and everything has to line up, right? Like A, B, and C, that might be your weakness. And so, of course, you have to be very flexible, with trading. And what I also pay attention, guys, to what he said about his decision making, right? So when he says something is bubbling up, he's not jumping on a trade from a gut instinct, meaning that, maybe a trend has been going on for quite a while. Now he evaluates, will this continue? And then he jumps on it, right? He doesn't have the FOMO factor, right? The fear of missing out. He evaluates things. So that's phenomenal input. So thank you. Let's go from the decision making now, going long and short. I remember a while back, you told me something that really fascinated me, because it's basic, but at the same time, the basics, that's what makes things good. I remember you told me that before you go long or short, you do the positive and the negative of every single trade, right? So day traders don't really have that luxury. Tell me a little bit about your process about making decisions of this positive versus negative, and if you were to go into short time frame, how would you apply it?
Yeah, look, it's really simple. The reason I want to think both about the long and the short is, if I'm going to go short a market, I need to know who's on the other side. There is a bull case for the market. Somebody else is long. Why are they long? Nobody's stupid. So I want to know both sides of the argument and weigh the two. So for every market I have on my screen, you don't have to go into a detailed analysis with a 30-page report. This is something on a half a piece of paper or a cocktail napkin, 2 bullet points for what the fundamentals are that are bullish, 2 bullet points for the bearish fundamentals, and just weigh the two. So when you put the trade on, you should know who's on the other side and what they're thinking. I'll give you an example in real time. Right now, to me, I'm bearish copper. I have a small short position. It's contrarian in nature. Everybody on the planet, I'm reading research all day long from the banks and from buy-side boutiques. Everyone's making the same argument that there's a shortage of copper, no new copper mines have been built. There's a major demand pull coming from EVs, wind turbines, the green tech revolution. Emerging Asia, whether it's India, Malaysia, Indonesia, is going to need to industrialize. They have the S curve of growth coming up, blah, blah, blah. So I can write down 4 reasons right there why copper is bullish. And then I can give you, other reasons why you might want to be bearish. The bearish reasons are everyone's in this trade. It shot up like a rocket ship. It's extremely overbought. The Chinese credit impulse is rolling over, and the credit impulse is what drives actual copper movements on a 6 to 9 month time frame. So I've got, there's my 3 bullet points to be bullish, 3 to be bearish. Now I have to decide, do I put the trade on? What's the chart saying? And then it becomes a judgment call. I know I'm going to be wrong a lot, but I want to at least know where I can put a trade on, put the stop loss in. So that's kind of the analysis behind why you want to have both sides in your head before you put a trade on. A day trade is totally different. The day trade, and I've done day trading before, it's really more about the setup. You want to look at the setup and have your discipline to only take the setups that look really good to you. If you're going to put on 10 trades during the day, you might find that you have 40 opportunities. You want to just take the 10 where it passes the 2 or 3 filters that allow you to put the trade on. It's a different mentality. You don't want to be sitting there confusing yourself about fundamental analysis, thinking about, electric vehicle demand while you put a day trade on. It's just going to mess you up. So don't worry about that. But still, you want to have the discipline to look at your setup. And just like I have to think to myself, do I want to put this copper trade on? I'm going to hold it for 2 months, even if it's a short-term trade. Do I really want to put this on? I want to understand the other side. Day trade or with a short-term swing trade, you still need the discipline to not just impulsively put the trade on because it starts to move up. Wait for whatever your criteria are, wait for that to actually get baked a little bit before you put the trade on.
Thank you. This is exactly, Asim is giving you good advice, guys. Like I always said, keep it simple, wait for your setup and do it. I want to talk about the psychological aspect of trading because we have to touch on, right? Before we get to risk management. So the easiest question to ask is how to remain calm, especially when, let's say you made a bunch of consecutive bad decisions, right? So we know statistics. So for example, out of 10 trades, if the setup appears 10 times, you have to take it 10 times. But that's not the reality with traders. The reality with most retail traders is that, they do 3-4 trades, and then it doesn't go their way. They'll change a method. They'll get scared. They won't take the 5th one that could have potentially, I should say, legally, potentially would make enough money to overcome all the other losses that they had. So the question to you is that how do you remain calm, in times where your decisions making is not aligned, when your decision making is consecutively wrong? I don't mean consecutively 10 times, but could be 2, 3 times, maybe 4 times. What do you do at the time psychologically? How do you evaluate if you didn't lose your edge, or is it just the market?
My answer is probably going to be something that's maybe not helpful to everyone listening, because the way I remain calm is when I started the business, I wanted to take advantage of big picture trends. So for example, a monetary reset and the fact that over the course of the next 10 years, precious metals will probably move up in price to reset the system. System hasn't been reset since Bretton Woods a long time ago, or maybe you could argue Nixon in 1971 in August when it was reset there and gold was floated. Or bonds move in 40-year cycles. You have a 40-year bull market in bonds. We're starting to make it slow U-turn, and you're going to have a 20, 30, 40-year bear market in bonds. These things sound crazy because I'm talking about multi-decade moves, but when I'm in a rut, if I'm losing money month after month after month, it's easy for anybody to lose their confidence. This business is 90%, for me, it's 90% psychology, 5% fundamentals, 5% technical analysis. And when I lose money, I don't just lose money for 3 days in a row. Matt can see my track record. He has clients invested. I lose money for 6 months, 9 months in a row, sometimes every month. It's happened to me once where I lost money 9 months in a row. Oftentimes you're going to have some wins, some losses. You make, lose, but I'll have 6 to 9 month drawdowns. If I can't get through that, I'm just going to crack like an egg and shut the business down. So if the way I get through that is I look at my big picture, multi-decade trends, where are we in the stock market? Okay, from everything I've seen, all my analysis, the stock market, given any of these big picture ratios, Shiller PE, Tobin's Q is probably a bad example, market cap to GDP, they're all projecting anywhere from a -3 to a +3% annualized return for the S&P for the next decade. All right, so I need to make sure I have a long-short mentality, and when it gets extremely overbought, I want to go short. I've been dead cold, let's say, for a long time, but I'm going to wait for a few trades to set up. And then if I'm wrong for 6 months, I just keep coming back to my long-term themes and say, look, it's going to pass. I'm going to get through it. But it doesn't decrease the stress for me. In my case, I'm running a business, and every single time I have a drawdown, I have clients closing their accounts. So I lose not just my own money, I lose clients' money when I'm in a drawdown. And then the worst part about it is every single drawdown, without exception, anywhere from 2 to 5 clients close their accounts. So I have to be able to sit there and say, you know what, even if everyone redeems from my business, and all I have left is my own money, which I have in the business, I'm still going to run it because I love what I'm doing. So it has to come down to that super long-term sense of the fundamentals for me. The fact that I know I've been through 7 or 8 of these drawdowns in the past 6 years. And then the fact that I love what I do. You know, this is it's a net negative game psychologically, I like to say. There's a lot of money in it if you do it right over time, but it's not like any other job on the planet. If you're a doctor and you're doing an operation, you get paid well, but you're getting paid by the hour. If you're stocking shelves at a convenience store, you're getting paid by the hour. If you're a lawyer, you get paid by the hour. It's the only job where you can put in a 2-hour day and make a fortune, and you can put in a 15-hour day for 5 months in a row and lose all your money. So it's a job where over long periods of time, your hard work pays off. But you can have stretches, in my case, of 6 to 9 months where I'm putting in incredible hours and I've lost money at the end of that 9-month period. So the only way I stay strong psychologically is thinking about the next 20 to 30 years instead of the next 2 to 3 months or even the next 2 to 3 years. That's why I said it's an answer that people are going to look at it and say, I can't think like that. It's too far out of my time frame. But for me, that's the only way I can build this as a business.
If you recall, one of our first conversations that we had, which I told you, when you had just a little bit of money under management, relatively at least to today, I said, one of the first people that you really should never listen to are brokers, because they would call you and they would tell you, why did you trade long? It was obvious short, it was this, it was that. And then I also mentioned customers, that customers will go out during drawdowns because majority of brokers out there, when they talk about money managers or when they talk about trading, they only mention the reward side instead of saying, look, you will go through pain. I always feel that the pain in this business, that's exactly, what comes with this business. Just some businesses have physical effort. Some of them have some sort of other efforts that are there. There's a mental effort here, like you said, and it's 90%, and 90% is mental, where you have to have the strength to go through this difficult period. But at the same time, I see that you also have the right perspective on the business. You're thinking, you still continuing, if there's any lesson to be taught over here, is that I've seen, yes, we do have customers with you. I've seen you going through tough periods, but I've also seen your ability to overcome it, and go to new highs. But again, it's a reflection also of your mental strength, not just your technical skills. And every trader should know this, because it's difficult, right? It's difficult because when they lose, nobody has endless amounts of risk capital. And at some point they throw in the towel, or what they do, which is even worse, if they have the money, they start changing things instead of tweaking things, right? So they go through major changes. So one day they'll trade Fibonacci, next day they'll find some course in order flow, next day it will be some super special indicator of a moving average that you can do it by yourself, but they prefer to buy it from somebody for $3,000. So it's important, thank you for sharing the process that you go through. Let's go to the risk management side. Okay, so the question is, how do you, well, let me ask it in the right way. When do you decide that your decision-making was wrong, that you were in the wrong position, that the opinion that you formed was wrong? So, for example, you're in the copper position right now, as you mentioned. At what point do you admit that you're wrong? Is it based on only on the price going against you, or price going against you at a certain level? or a certain level of or things have changed along the way. So when do you admit when you're wrong?
And for me, for my strategy, this is the classic old school style of discretionary global macro. So what I do is I risk anywhere from 50 basis points up to maybe 2% of account equity on any given trade. So when I'm wrong, it's the distance from the entry to my predetermined stop loss point. Now that stop loss could be outside of the daily, weekly volatility. It could be inside of some kind of a spike top on a candle chart, whatever it is. When I enter the trade, before I put the trade on, I look at the chart, I pick a point that's going to be my stop loss. And it's a super simple calculation in Excel. You have your entry point, you have your exit point, you know what percent of the account you want to risk. Let's say it's 1%. And then the math just spits out how many contracts I can sell short or go long. Let's say it's 2 contracts of copper. Now, I'm wrong as soon as it hits my stop. That's when I get out. That's when I decide I'm wrong. Before then, I'm very optimistic because you want to think the best thing is going to happen. As soon as it hits my stop loss level, I'm out no matter what. If I have to put that trade on 4 times in a row, I'll put it on 4 times in a row to get it. And then at some point I'm just totally wrong on the theme and I'll walk away. There are many, many times though where that trade gets stopped out and I hate it because I know it was the right trade. I know I should have held it. It still gets stopped out and it reverses and goes in my favor. And I wish I had not taken it off. The reason you have to take it off is 1 time out of 50 or 1 time out of 100, it'll just keep on going against you. And instead of taking a 1% loss, you take a 20% loss, and now you really damage the account. So I always take the trade off when it hits that stop. There's no other way to look at it. That's when I know I'm wrong.
I'm so happy you mentioned it because one of the things that I preach to people out there, when they say I don't use stop losses, or they say, or a day trader that says, I'm just going to keep it this time overnight. I always tell them that, many times it could work in your favor doing the wrong thing. But the one time, that it won't, it will absolutely kill your account. It absolutely will do that. So I'm happy you mentioned it. By the way, again, guys, because we're both licensed, just a disclaimer on the stop loss, that there could be very difficult market conditions out there that you don't get executed exactly at the price of the stop loss, and in such conditions don't such as gaps and things like that would throw you at a totally different price. Okay, let's talk about the reward side, the more positive side. So when you decide to take the position off, okay, so now you made a decision. Is it the same process as the stop loss, where you said this is the percentage I'm out, or on the upside, how do you maximize it to the best that you can with the position?
It's similar in the sense that before I put the trade on, I have a rough sense for where I think this is going to go. So I have a profit target. So again, it's based on the chart. If I'm very bullish, it's going to be very, very far away from where we are today. But I still have a rough sense of where I want the trade to go. And my job is to try to hold it as long as I can. There are times where I make mistakes. I take the trade off too soon. That can happen. But broadly speaking, you want to let your profits run. I mean, the business is super simple at its heart. You want to cut your losses short, let your profits run, keep your bet size small. Those rules have been laid down for the past 400 years by different traders who've come and gone. And I think they're going to work 400 years from now. But with the profit side of it, I'm running, again, old school, slow moving, long hold process. So some trades I have, my short-term trades are going to last for 3-4 weeks. My long-term trades are going to last for 4 or 5 months. And so I need that profit target to be fairly far away from where I enter. The way I think about it, though, is for my short-term trades, if I'm risking $1, I'm trying to make maybe $1.50 or $2. So call it a 2-to-1 risk, 2-to-1 return to risk. And for my longer-term trades, I'm trying to risk $1 to make $5 or make $10.
Nice. Okay. Going back to what you discussed before, as far as re-entering the trade, just, let me ask you this. So when you re-enter the trade, how fast would you re-enter the trade after you got out? Do you take time to think about it, or you say, I just got stopped out, nothing has changed, I'm going to re-enter? How do you make this decision to re-enter, as opposed to, because one thing I don't want to create impulsive behavior with traders where they get stopped out and they keep on jumping on the same position, because many times what they will do, Asim, is not only would they jump back in on the same position, many times they would even take a larger position to recover, right? So they traded with one lot, they lost one lot, second lot, third lot, and they're like, okay, just this time, I'm going to go in with a 10 lot, try and recover below the account, right? So how do you avoid the decision making of not re-entering just on impulses as opposed to, yes, my method is still there?
In my case, I have the discipline of only trading off that end of day data. So if I get stopped out at 11 a.m., I'm like anybody else. I look at the chart, I'm still bearish. I want to put the trade on 5 seconds later. Or, I really want to put it on half an hour later. But my discipline and my rules are such that I can't do that. I never trade intraday. And so I'll wait till, again, 7 p.m. at night, download the data, look at the daily candle, what happened. There are times when I put the trade right back on. So I'll wait a day, put it right back on. But oftentimes I'll wait a few days. Sometimes I'll wait a week or two. Broadly speaking, my rules, though, are if I try a trade 3 or 4 times over the course of a month and a half to 2 months, and I'm wrong for 4 times, I just walk away. And when I say I walk away, I'll walk away for a quarter or two. And by then, 6 months go by, the chart has changed dramatically. And maybe you look back and you say, wow, that's stupid. Why was I doing that? It made no sense. Or it'll set up and you'll say, you know what, I'm glad I took a breather. I can go back at it. But forcing myself to trade off daily data means that when I get stopped out, I'm not able, just based on my rules, to get right back in 5 seconds later. It's easier for me today, now that I have a team, I have 2 people sitting next to me. If I start doing stuff that violates my rules, I'm going to get called up by my risk manager right away. So it's tougher to do it when you're sitting home by yourself. You can break every rule. And that's what I did for the first 8 years. I would break my own rules. And that was how I lost money for the first chunk of my trading career. When I knew what the right thing to do was, I still did the wrong thing. That's why the business is actually really hard. After about a year of trading, you really have internalized a lot of the lessons. You don't make the stupid rookie mistakes anymore. But between years 2 and year 5 or year 8 or whatever it is that most people give up, they find in their subconscious, they know it. When they go to bed, they know it, but they end up making the same mistake over and over again. And that they do something even though they know they shouldn't, but they just can't help it. That's why the business is tough. And that's why I stick to those daily data points. If I want to put the trade back on, I have to at least wait 24 hours.
Okay. Do you go and review your trades once you have a little bit of stats? Let's say you said you make only, because you're a long-term trader, you said you make 125 trades per year. Do you do at the end of the year a review of your decision making, looking at past trades that you have done?
I do. I log every single trade. We log them in the multiple places in the database in Excel. I've been doing that, though. Even when I was running my own PA before the business, I logged every trade in Excel. And I would review them monthly, quarterly, annually. I would do a deep dive annually. I'll say this. Every professional tells you to keep a trading journal, to review your trades, learn lessons. I think it's helpful, but I also think it's a little bit overrated. Sometimes you look back at your trades you made 3 months ago or a year ago, and you don't remember exactly why you put that trade on. It could have been a trade where you made a mistake. You shouldn't have put it on. It's hard to sometimes take a lesson from it. I think over time, one thing that's been helpful is when you make the same mistake over and over again, 3, 4 times in a row, that's where you're almost better off taking a pen and writing it down in ink and having some kind of a curated list of your key mistakes and maybe tape them onto your monitor with a sticky note. If it's a list of your 12 most likely mistakes that you've made, after about a few years, you can internalize those key rules or lessons about your personal psychology. I have this impulse to re-enter and double my position, like you were saying, Matt, to get my losses back. That could be one of your things. Sometimes you look at your individual trades and you don't really get as much out of it. I still think it's a good thing to do, but over time, you should figure out yourself and know which mistakes you just make over and over again. And those general heuristics or general rules are the ones that you really want to write down and put them in a place that's visual. Put them in a place that you're forced to look at it. Even if your girlfriend or your wife yells at you and says, I'm going to throw this away, just say, no, leave it there. I need to see that when I open the fridge. Wherever it is, it's important. It'll sink into your psyche, but over time.
I can appreciate that. Thank you. One thing I want to ask you next is the use of leverage that you make. One of the things that, and again, because we're both licensed, past performance, not indicative of future results, one of the things that impressed me is how you were able to navigate with such little leverage during COVID and yet come out with such amazing results. So the question to you overall, I know that there was, I know that there were very difficult times during COVID. You navigated them like a champion. And to me, it's very important to tell customers, the leverage. Now, let me tell you why I'm asking you this, okay? The retail crowd thinks that brokers push leverage, right? So they think we want to open small accounts and give them as much leverage as possible. The reality is this demand is coming from retail, really. And I'm just telling you and I'm telling my viewers, right? Because sometimes we put on our account opening, the leverage for this firm or that firm is very low, but that's because of retail demand and I want to stay in business. Nevertheless, as an individual, I always tell them, don't over leverage your account. It doesn't do anything, right? So now I want them to hear from a professional who does it for a living, who actually has his money in the market, customers' money being managed. What is your approach to leverage? And in particular, how do you leverage each position? Do you rank each trade to say, this trade ranks from 1 to 10, I'm going to take this kind of leverage, and this trade I'm going to do this way? Or is it based on the notional of the futures? I'm going to put 3 gold and 2 copper and 1 e-mini. How do you decide on the leverage to use on the account, number of positions?
Yeah. Look, you need the leverage is a dirty word, but the reality is on some of the best trades out there, you want to have some leverage. You want to have a good exposure on when you're really riding a trend. There's nothing wrong with leverage if you use it carefully. The problem is people put on too much and they keep a lot of leverage all the time. Professional trading is about using very little leverage a lot of the time. And then when you see something great and you want to go for it, that's when you want to add leverage. So it's knowing when to press your bets, which is rare, and when to be careful and constantly take small losses, sit in cash, take small losses, sit in cash. So the way I do it is I'm risking anywhere, like I said, from these days, anywhere from 25 basis points up to 2% of equity on a trade. So what that means is if I'm in a rut and I'm getting stopped out a lot, I'm not using much leverage. If the account, I'm just gonna make up a number, if the account has 100K in it and I put on a few positions, maybe it's got 150K of notional exposure. So there's a little bit of leverage in there, but maybe I'm using 10% margin to get that exposure or 12% margin to equity. That happens for most of the year. And then 2 to 3 times a year, I see something and I'm right. And I'm getting into a major move and I put the trade on, it's moving in my favor. Again, I'm running this old school style of macro. In the old school macro style, you add to winners as they move in your favor, not when they go against you. So if it goes in my favor, I'm going to add a little bit more to it. Maybe I'll add a little more if it goes in my favor further. So I can add up to twice to most of my trades. And then if I ride a winner for a while, I end up with a really good return. And you'll see that the margin to equity starts to increase in my client accounts, in my own personal account, as I'm doing well and riding the trend. So most of the time, I'm 6 months of the year, I'm kind of going sideways. 3 months of the year, I'm maybe losing some money. 3 months of the year, I'm having a great run, making a lot of money. In those 3 months where I'm making a lot of money, my margin to equity is going up towards 20, 25% sometimes. And I'm putting on now 300, 400% exposure in that 100K account. And in the other 9 months, I'm running between 100 and 150, 175% exposure, constantly getting stopped out in a lot of trades. The problem is if you're really new to the business or if you want to blow up your account, you can take a 100K account. You can put on, 2,000% exposure if you want to by putting on an insane
notional funds.
Yeah,
in notional funds.
Yeah, sure. Yeah, just because the margin for the margin might be $2,000 for a Eurodollar futures contract, it might be $5,000 for an energy contract, and you can load up the entire account and put on an 800% notional position size. You're gonna blow up. So you have to make sure that you use very little leverage most of the time, and then when something starts to move in your favor, you want to dial it up quickly and then ride it and then take it off. So it's all about knowing when to press your bets and knowing that those opportunities to press bets, they only come around, for me, they come around a few times a year.
Do you feel that since we're talking about margins, something that I tell customers, I want to know if you feel the same, that the margin required to trade futures does not indicate really the risk that is entailed in that contract. when you talk about, for example, the Widowmaker, natural gas, right? You can have times that it's $2,000 and the market can move $10,000 on your account. So somebody with $5,000 can get wiped out and potentially be left with a deficit. What's your criteria as far as the risk of the product? Is the volatility in the product? Is it also the margin? Is it potential historical moves that have happened in the past? How do you define the risk in each contract? Because you trade, you're exposed in quite a lot of contracts and physicals as well. So what's your perspective on that?
I ignore the margin completely. To your point, the margin is set for different reasons. The margin is set for both professional, money managers and for hedgers, so they don't have to tie up all their capital. The point of the margin is to allow people to optimize their cash. So if you're gonna, hedge your jet fuel and you're an airline, you shouldn't be putting up all of your cash to put your derivatives trade on to hedge your book, hedge your balance sheet. You want to, not tie up your cash. So the margin is meant to help a hedger manage their balance sheet. It's meant to help a money manager put on their exposure, knowing they have the cash to do other things with, so they can calculate their own internal, metrics on how to use their capital. The margin is not set for the retail trader. It becomes dangerous. For me, I ignore the margin. I don't care about the margin. I only care about my entry to my exit, and I want to put in a good buffer in case I'm wrong. And to your point, you made a good comment for, legal purposes. You made the disclaimer. Stops don't always work. Sometimes you get skidded. So I want to also know worst case. I might take a bit of a bigger loss, but entry to my exit, I'm going to risk 50 basis points. If the account has 100K in it, I'm going to risk, $500 in that trade. And I don't care if the margin is $1,000 for that T-bond contract or if it's, $20,000 for some other contract. I'm just thinking about the risk of the trade, and the margin. Then I just want to make sure I have enough capital in the account so the margin, can go through, and so you don't have a margin call. But tend to use anywhere from 6-7% up to 20% margin to equity on average across my accounts.
That's very reasonable. We have a few customers here and there who probably still do it because they have experience in it. But for the most part, I walked away from the business of option selling. I found that it's one business that is so deceiving in terms of the margin. You can have out of the money option that people sell and collect premium, and they think it's a gift, and the margin is so small. And yet this is the one option that they can't get out of when you have huge moves. This is the one that just inflates in value, no demand. So I'm very happy that that you have explained better than what I have. The purpose of margin. You're right. It's for hedgers and not to tie up capital. And companies need their capital. It's not an indication of risk. One more question I have is, let's talk for a minute about the different groups of commodities and futures that are out there. You tend, and correct me if I'm wrong, not to get into the stock indices, right? The retail, on the other hand, is all in stock indices because that's where the liquidity is at, right? Especially for them, and I'm happy for them. They have the micros right now that have become really popular, which is 1/10 of the size, which is a great way to at this point at $50 E-mini S&P or $20 on the NASDAQ, when it moves like that, all of a sudden it becomes 5 points and $2, which is a lot more manageable in my opinion. But you tend to be more in the physical space, more in the other spaces. Tell me a little bit your opinion about stock indices versus energies versus gold as a trading vehicle.
They're all the same to me. The reason I tend not to do as many stock index futures trades is I find that there are two reasons. One's a business reason and one is a risk reason. The best moves in equity is the big, sharp, trending moves on a short horizon. If it's a 3-4 week short-term trade for me, is often on the short side. You can risk $1 to make $5 because markets, there's the old adage, they take the staircase up and they take the elevator down, right? So that's one of the reasons. But the main reason for me is more of a business reason. It's not relevant to a lot of people listening. Allocators that look at me, whether it's an endowment fund or a pension or a ultra high net worth family, they already have a huge amount of capital tied up in equities, whether it's private equity or mutual funds or equity long short hedge funds. So they like the fact that we don't carry embedded equity beta. So I'm not just taking the S&P futures contract, putting half the account into it and rolling it forward for the next 10 years. So they don't want to see that. They want to see pure alpha from a macro fund where you don't have embedded equity beta. So for me, it's a bit of a business reason to not carry equity beta. So that's kind of one of the reasons. But the other thing is, for me, again, I'm longer term. So if I were to carry equity exposure, I would think, is the stock market going to trend higher for the next, say, 12 months? Maybe I want to put on a small position and roll it. That would be how I would do it. I think day traders look at it very, very differently. They're looking, again, to make a higher return or to put on a lot of trades intraday, a very different strategy. But I do trade the equity index futures contract. I just tend to be more trading it from the short side than the long side.
I see. I should really give some chance to some people to ask questions because we're coming soon to an hour. Evan, I'm just going to ask him one more question, and then I'm going to give you a chance to ask him. I'm very interested in the decision making that you guys work as a group. Most individuals are there. Nobody can criticize their trades, give them feedback or anything like that. You have a team there. What would you say to an individual, that is sitting there by himself, and does not have a team in terms of decision making? What would you do? That's the question.
Look, you can do it. I don't necessarily rely on the team to push back on me. They don't push back. Their job, I have a risk manager whose job it is to close out the positions if I'm violating the rules. But I don't violate the rules anymore. I haven't done that in many, many, many years. So it's more a question of, you have to just over time develop your psychology, get your mental strength so that you don't make the stupid mistakes. Everybody wants to make money. Nobody wants to sit there in a 6-month drawdown. You're tempted to put on a huge position. You see something interesting, you want to get out of the drawdown. You just have to have that discipline to sit there and keep on putting on small bets until you see something big. My thing, having done this for this is my 20th year. So after 20 years of doing it, I know for a fact there's always going to be a great opportunity coming up. Any given year, I'm going to have 3 to 5 amazing setups. I'm going to have another 15 or 20 smaller setups that are going to work. You don't have to worry. You can sit in cash for a week. It's not going to kill you to be in cash for even 2-3 weeks. Find that next trade, get out of the drawdown. It's only when you break your own rules and you start to put on that 10 times too big position because you just want to get out of the drawdown, you can't stand it anymore. That's what causes problems. When you sit alone at home and you have nobody looking at your track record, you don't have clients, you don't have a business partner, it's harder in some ways because you only have yourself to be accountable to. It's always easy to blow up your account, go get a beer and drink it off. But you need to just have that discipline to say, you know what, I'm going to be successful. I'm going to be that guy that makes it. I don't want to be those people who are sitting there at the bar telling stories about how they used to trade futures and lost all their money. You can do it. It's got nothing to do with intelligence. Like I said, in some ways, you're better off being of average intelligence or a little bit above average intelligence. If you're in the top 1% or top 2% of intelligence in the country, you're at a disadvantage, in my personal opinion. It's all about your psychology and your mental strength in this business. It's 90% of the game.
I agree with you. For a long time, just like you, who made all the mistakes in the book in the early years. One of the mistakes that I've done in the early years that I was not competitive enough in my personality to win in this game. I thought it's about the method and it's about, when I started realizing how competitive it is, and a lot of this business is not to do the garbage that 90% of the people do, but do what 10% of the people do, stay disciplined, do the things that you do today, then it really clicked how competitive you have to be, where basically the markets will always be built from those who are making mistakes. And the ones who are not making those mistakes, those are the ones who are reaping the rewards. So I can definitely appreciate, where you're coming from on that. I'm going to, Evan, you want to ask him a question? Now, before you guys ask him a question, I just want to make sure you guys understand that he's in a very competitive business, okay? There's a lot of money managers out there. So please don't ask him, what kind of positions he has right now, or anything like that could expose his proprietary method. I was trying to have a very general talk with him. I'm sure there's a lot of things that he does that are different than many others. But again, if those are general questions, go ahead.
I think my question is general enough. Okay, many of the people on this platform, in your audience right now are day traders, much different from what you're doing. I get that. But can you speak to some of the, kind of live vicariously, pretend you're a day trader for a second, and summarize some of the questions that Matt talked about that would help? And there's many that you have pointed that, basically will go ahead and apply to any kind of trader. But kind of live vicariously for 2 seconds and speak to that day trader for a second.
I'll make one point on day trading that might help address it. I did try day trading. I did it for a few years unsuccessfully from 2001 to about 2004. And I do, because my business is to manage money, I still stare at the charts all day long in case we get stopped out of a position. So I'm looking at the minute charts, the 5-minute charts, the hourly charts all day long, and I'm noticing things. I'm not trading off that, but I am noticing things. So the one thing I'll say is, if I were to day trade, if I were to live vicariously, as you mentioned, and try to think about day trading, I would want to know that whatever strategy I'm coming up with is stable over time, that I don't have to reinvent myself all the time. So the problem is, back in 2004, just to give you an example, the chart patterns that would show up on a minute chart, a 30-second chart, a 15-minute chart, were mainly being made by human traders. And they were very different. They were difficult, but they were also stable in their own ways. And then you fast forward to today, and 99% of the volume is coming from algos. And so the patterns on a 1-minute chart, a 15-minute chart, look nothing like the charts from 2004. I used to take screenshots of different short-term charts, and I sometimes pull them up and look at the charts today. They're totally different. So I think what I would think about as a day trader is, if I'm going to do this for a living, I want to do it for, say, 5 years or 10 years or 15 years, what could you do to avoid the issue of getting wedded to a style that comes down to pattern recognition? Because the participants change, the markets change radically every 5 to 10 years. The people involved and the way that the markets trade at a microstructure level changes so radically that, for me, when I started to sort of abstract myself and think about it, I could not figure out a way to be profitable, because I couldn't get some kind of stable distribution, call it, that I could kind of play off of. So that would be my number one concern, to figure out, what can I do from a strategy perspective? Maybe it's in the risk management part of the business. Maybe it's in waiting for very particular setups and walking away from 9 trades out of 10. Whatever it is you have to do, you have to win the battle against the fact that the participants are always changing, the microstructure is changing, and it's a very different look and feel every 5-10 years. The chessboard changes. I was a math major in college, and I first came into the markets. I thought I could apply my kind of math econ background, kind of a quantitative approach. I flipped that upside down and took a completely qualitative, art-based approach, because I was unsuccessful at applying math to the markets. But it's doable. I'm not saying it's not. There are people who've done it successfully. My advice would be to figure out something that prevents you from getting picked apart by the fact that the code and the algos and the participants are always changing the game and changing the structure and changing the patterns when it comes to day trading.
Thank you, Asim. If you guys want to maybe post some questions in the chat, I could ask Asim as well. By the way, listen, I really appreciate your time. You have a really nice office. It's you know what? I always say aesthetics sometimes make such a difference, like when there's no clutter around you, and it's clean, it helps.
I was going to say one thing, by the way. People want to ask me what positions I have. I actually don't mind talking about it. Here's why. I'm wrong. I have my own data. I'm wrong about 60 to 65% of the time on my trades. So if I went on TV on CNBC and told people my trades, I probably am going to get stopped out on more than half of them. And then the very next day, even though I give you an argument for why I'm bearish and I'm short copper, a week later, I might go long copper for the next 5 years. So you got to be careful. When you go and look at people on TV, half the time they're talking their book, they're trying to liquidate a position. You never know. And in my case, I'm a trader. I'm not even an investor. And my trades are going to look very different day to day, week to week, month to month. So there's no value in knowing what I'm doing, but there's nothing to hide really either.
All right. Well, one thing, that people sometimes always ask, and do you think this question is overrated as far as what's a win-loss ratio? Because some people are, majority of people love to hear that I'm 70% profitable and I'm 30% loser, right? Where it could be, in your case, it's exactly the opposite. 66% of the time you're wrong and 30% of the time you're right, and you have an exceptional track record. So, sometimes when they ask this question, sometimes I think they want to hear a certain answer already, right? So here's a question. Thoughts on swing trading for beginning. Just one thing, discussion is okay. You guys are very welcome. Let me just see here. 1 second. So one of the questions here, so Kyle was asking thoughts on swing trading for beginners. But if a beginner wants to get into swing trading, does he need large capital? Should he avoid it right now?
I don't think you need large capital. Swing trading to me, and you can correct me if I'm wrong or if Kyle has a different definition, but to me, when I think of swing trading, Tudor Jones was the classic swing trader. You're holding positions from a day to a week. Let's just call it 3 days to 4 days on average. That was my perception of swing trading. You can do that with a smaller account size. I think you could do it maybe with a 25K account, but maybe 50K to 100K, you can definitely swing trade. I tried it. Again, it's one of those styles I tried for about 6 months to a year, failed, was not profitable. Swing trading is definitely, you need to be a great trader. I'm not a great trader. I have my style. I have my feel for the markets. I'm profitable over long periods of time. I know I win over long periods of time, but I make even today, I make mistakes when I execute trades. I put trades on I shouldn't put on. If you are a truly outstanding trader, like a Tudor Jones, where you have a natural gift in some ways for the markets, and you just find these skewed risk reward trades, that's something to look into. I don't have advice because, again, for me to give advice on swing trading, I should be a good swing trader, and I'm not. So you don't want to get advice from me on swing trading.
All right. Well, I like your attitude. You say I'm not a great trader.
No, you want to be honest about these things. The shorter the time horizon, the worse I do. So that's why I lengthened it and became profitable. So my trading is a meld of trading and investing and fundamentals and technicals. It's not pure short-term day swing trading. When you hear the word trading, it's a stereotype, and I'm not that stereotype.
I got you.
Hey, Matt, I have a question real quick.
Sure, Ben.
First of all, thank you. Listen, it's awesome to hear you and kind of learn about your experience. The one thing that stood out to me was the fact that you said, like, people can be smart and they won't make it, and other people can not have that academic background and just kill it. And I saw that. I traded in a shop in Chicago, and we had people from Harvard and MIT, and then other people that would come in for an hour and in their shorts, no school, and they would kill it and walk out. So that goes back to the psychology of it. And I forget what year it was, but maybe 2007, where I think you said things finally started to turn. I'm curious to know with your psyche, what changed? Was it maybe your relationship with money? Was it saying, I don't care about money? Or was it a self-preservation thing? What changed there?
I think it was a couple of things. One, I was older. I'd been doing it for a half decade, so I made a lot of mistakes. That helped. I'd already kind of gotten through all the worst part of it, of making the same dumb mistakes and learning. The learning curve part was over. I was still making mistakes, but the learning curve part was in the past. Number two, and I think this is important, I had a day job. My entire time that I was building up this pressure, building up this desire to do this for a living. And I mentioned I tried getting jobs on Wall Street, failed. Eventually I knew I wanted to start my own business because it was the only way I could do this for a living. But the entire time I had a day job, and the day job I had from 2007 or even 2006 to 2012 was at a consulting firm that was an investment consulting firm. We had access to tons of research from buy-side boutique firms, sell-side firms, and I could spend a third of my day reading research and learning about the fundamentals. So during my day job, I was reading all this research and very slowly understanding how to think about fundamental analysis. I had no idea before. I just said, oh, okay, the Fed's raising rates, therefore the dollar must go up. And simple stuff like that doesn't work in the markets because the markets look at real rates, not nominal rates. I didn't know that. So basic stuff, or even just the way they anticipate things, or the way signals break down. So I spent the next, 4 or 5 years getting access to a lot of great research. And over time, I was able to then incorporate my understanding of fundamental research with my trading. And then the next level that helped me even more was figuring out that, wow, even these professionals don't know what's going on. So some of the best trades for me popped up when everybody from JP Morgan to Goldman to Merrill Lynch to Alpine Macro to BCA, the buy side boutiques, the sell side boutiques, when they're all saying the same thing, but the chart has started to disagree, that's where some of the best trades come. And even today, I use that rule for a lot of my trades. So I think I made a lot of the mistakes. And then on top of that, I was getting access to tons of great research in my day job that I now pay for because I can afford to, and I've carried that over. So I have a kind of a confluence of good things that happen. It's really tough to do this business when you're doing it and let's say you think 250K is enough to live on, you put that into an account, you have no day job, you need to live off the account. That's where a disaster strikes. You need the learning curve, whether it's 2 years or 20 years for you, whatever it is, I think you need to do it while you have some other source of income coming in.
Cool,
I
thank
agree.
you.
I agree. I always tell people, that majority of the time, I always say, have trading as a side job, or as a side career until you really prove yourself that you can do it. Two more questions, guys, because, we're past the hour. So there was a question here. Okay, so the do and don'ts of trend. Okay, do and don't about future trend interpretations. So what are some of let's start with the don'ts of trend interpretations.
Trend interpretation?
Yeah.
I'll say something controversial. So I've read probably 100 books on trading. Most of them are junk. Some of the things and some of the people who I think, when I look back, they're people who put these strange rules that you must have this for a trend to be, sustainable or to be real. I'm going to give you an example. I'm not picking on him because I actually think he's a legendary trader, and I have his book on my shelf. It's one I think of the best books on trading. But he made a comment in the book that today I think is wrong, and it's Trader Victor Sperandea. I don't know if people know who he is. His name is Trader Vic. He wrote a book about trading. He makes this comment that for a trend to exist, you must connect lows. So whatever trend line you draw on a chart, if the trend breaks through that trend line and then continues, it's a failed trend. You need to redraw a trend line, something to that effect. It doesn't make any sense because you can have on an hourly chart, an algorithm can fire off and break through a trend line because somebody liquidated, they were forced out of the market. All kinds of crazy things happen, but the trend itself is going to continue if it's there for certain fundamental reasons. Step back from your screen, look at it. If it looks like a trend, it's a trend. It's that simple. You don't want to overthink it. Again, this business works when you abstract and start thinking at a higher level of what's going on. You don't want to get too many rules. A simple moving average should pick up on a trend. Your eyes should pick up on it. If you zoom out, get up from your computer, back up 20 feet, look at your computer. If you can still see it as a trend, it's a trend. It's that simple. If the question was more about trying to anticipate a trend ahead of time before it kind of really makes its major part of its move, that's a totally different question. And that's impossible to do in many ways because of how many false breakouts you have. And if you could do that and only capture, great trends ahead of time and not put the other trades on, you'll become a billionaire in a few years. But that comes down to whether you want to do a trend following system or be discretionary. There are all kinds of trade-offs and pros and cons, but there's no easy way. There's no sort of simple, easy way ahead of time to forecast a trend, is what I would say. But identifying it halfway through or even 3/4 of the way through, don't overthink it.
I agree with you, and I want to tell you something. I agree with you about the literature out there. A lot of the literature that is written, a lot of the courses that are being taught, when you come to our theoretical, when you come to somebody who doesn't know anything about trading, and 1% more than them, you can impress them to a level of, this guy's a genius. Wow. And when you start trading and you go through this experience by yourself and you see what's real and not real, then you end up taking all the books that you ever read and throw them out and you start over. And now you start listening to practical people. This is what I try and do. There's tons of books out there that I've read as well, just like you. There's some famous book out there about price action. Everybody goes by that. Complete garbage. Interprets every single bar. This is why the price went up. This is why the price went down. This is why it went down again. And people, it's just a clutter. They create a clutter in people's mind. So Jeff asked a question about if small traders, I'm going to answer it, have a chance against algos. Don't trade against algos. You know, like people come to me and they say, you know, I have a strategy for one tick. No, you don't. There is no strategy for one tick. It doesn't exist. There's no risk reward for one tick. It doesn't exist. You know, it's coming for paper traders. Don't be in their lane. Algo or high frequency trading, they're looking for subpar millisecond execution. Don't be in their lane. SM is not in their lane. You look for a different time frame, a different edge in his trading. When you trade, look, you know, for something that doesn't compete in frequency and time. So do I think you have a chance? Yes, I do. If you start competing with those who have better equipment than you on strategies that they try to capitalize on, then you won't have a chance. All right, so we're going to go with the last question. Okay. You obviously have a strategy. Do you consistently look to improve your strategy? If you consistently look to improve, how many times do you think you have made improvements since 2007? And this is for Mike.
It's a great question. And the answer is yes, I definitely look to improve my strategy. The strategy itself is so simple. It's a common sense based thing I'm looking at. Again, you know, oftentimes multi-year moves take out 3-4 month chunks, and on my contrarian short-term trades might be a month long. I don't think that needs to be improved so much. Every mistake I make is again, mental, psychology based. I look to improve upon that. I still make the same mistakes sometimes that I made before, where I put on a trade, you know, 3 times in a row, and I take it a 4th time when I know I shouldn't. I should have just walked away, and I lose another 1% of a client's account. Couldn't have helped it. You know, I should have not have put that trade on. So it's all the improvements I'm trying to make are all about discipline, trading less frequently. Maybe should I just switch towards weekly charts instead of even worrying about daily charts? I've thought about that a lot. It might improve my performance, my drawdown profile. But it's just the improvements I'm trying to make are all based on my own discipline, the mistakes I make. It's not so much about the strategy. The strategy is not even the most important part of the business. The business is all the mental side, really. It's funny how you could tell a 6th grader, maybe even a 5th grader, what trading is about. And it goes back to let your profits run, cut your losses short, keep your bets small. So the business, to me, analytically, the analytical side, the strategy side, that's not the, you know, the intellectually amazing part of the business. The real intellectual horsepower needs to be applied to the psychology of staying alive year after year when it's really a net negative game mentally. So it's fascinating to me how little people talk about the psychology of it.
I appreciate all the input. I appreciate the time that you have come here. I look forward to keeping in touch with you. I know we had a hard year. I was supposed to visit you this year. I was really looking forward to coming up to Boston. Hopefully things will get better. So again, your time is really appreciated. What you said, the rules, your attitude, the approach, it's golden for traders. I hope that it will make a difference for people out there. I wish you well in your own program, you know, and also the people behind the scenes. Say hi to Roger for me. I know he's working hard, and the new staff, right? So I wish them well. So thank you again, guys. Thank you very much for coming. Before I say goodbye, please go to that thread. Jake or Ben, if you want to push it again. If there are questions that are important to you that were not addressed that due to lack of time, okay, please put your thoughts over there, put your questions over there, and we'll do that. And again, whoever posts, please make it lengthy. Please make it count. Don't just put one-liners. You know, go into depth about your own weakness, what you want to become. Go into, you know, some sort of a story of where you want to see yourself, what kind of trader. And, you know, and again, I will send you the book to keep you motivated. Like Asim said, it's a business of psychology and motivation, and I want to keep you motivated. So thank you everyone for coming. Asim, again, thank you very much for your time, and I look forward to keeping in touch. Stay safe, everyone. Take care. Bye-bye.